As usual, I'm late to the ASX travel stocks party, and since there are new developments in the travel sector, such as Webjet raising 100 million euros worth of convertible notes and Flight Centre securing 65 million pounds worth of debt facilities, and Victoria going to shut down again, I want to give my take on whether these travel stocks have deep value that can be unlocked after the pandemic. So here's what I'm going to cover in this video. One, I'm going to give you a quick update on the recent developments when it comes to the travel sector. And then two, I'm going to talk a little bit about the financials and the economic moat of Flight Centre and Webjet. And then three, the future prospects of the travel industry, as well as which one I will pick if I had to pick one. And then I will wrap up the video with an update on my portfolio.
And I think you're going to laugh at the stupidity for buying the stocks I did.
This is going to be a bit of a longer video, so I'll leave timestamps in the description box below, so feel free to jump to whatever section that you feel most interested in. So without further ado, let's get set. So here's a quick update on the travel sector. Now, record high cases have caused Victoria to go into shutdown again, and if you're watching this video from Melbourne, I hope you're safe and well, and please stay safe. Now, on top of that, a plane of passengers from Melbourne have landed in Sydney without getting health screened. Authorities have dealt with this really quickly, which I'm really glad to hear, but there was a very important quote from one of the passengers on the plane saying that the plane was completely packed. And to me, that's a great sign to showcase that people want to travel. Now, Queensland borders have come down, welcoming approximately 238,000 Southerners, except for Victoria, to prevent a second wave. And Webjet have raised 100 million euros in convertible notes, which is approximately 160 million Australian dollars to fund takeover deals, as well as boosting the liquidity. And last but not least, Flight Centre have secured 65 million pounds in debt facilities to help offset the pandemic's impact on the UK business. So those are essentially the key updates, and we don't really know how long it'll take until we can travel internationally, but it's a positive sign to see that people do want to travel interstate. Now, before I talk about the numbers and also the economic moat for both Flight Centre and Webjet, I'll just go over the key differences between the two. Now, Flight Centre and Webjet, they're both travel agencies, and the key difference really is in their distribution strategy. Now, by distribution strategy, I mean how they are selling their products to their end customers. With Webjet, their core focus is mostly online, whereas for Flight Centre, it's a blend between retail and also online. As I'm recording this video, Flight Centre is trading at $10.81, and the market cap is approximately $2 billion. Whereas Webjet is currently trading at $3.18 and the market cap of $1 billion. So with that out of the way, let's talk numbers. Since travel sector is one of the hardest hit industries, make sure you take the historical numbers with a grain of salt, because I think it's gonna take a little while until they can get back to their glory days. And there are a few key things in earnings growth, balance sheet, and economic moat I want to point out. So let's start off with earnings growth. Over the last 5 years, Webjet have grown their earnings by 21%. And this trajectory of growth is largely driven by the Webjet's B2B business. Now, the thing you need to know when it comes to the Webjet's B2B business is that it's a double-sided marketplace. And traditionally speaking, it has always been really difficult to pull off double-sided marketplace profitably. It's difficult to pull off a double-sided marketplace because you need enough supply on the supply side, and supply could be hotel rooms or flights, to match the demand coming from the demand side, so retailers or anyone who wants to purchase the hotel rooms or the flights. And you need to do that with a low enough customer acquisition cost on both sides to make it profitable. And then there's an added layer of technology complexity because both sides needs to be updated in real time to give the most accurate depiction of availabilities. Now, if you can't update the inventory in real time, it means that people are gonna get the wrong information and customers are gonna get angry. It's just a mess. And Webjet grew that double-sided marketplace to $67 million in 3 short years. Now, compared to Flight Centre, over the last 5 years, they have grew their earnings by 0.5%. Now, even though their earnings only grew by 0.5%, just remember that Flight Centre is a significantly more mature company, and their earnings on the 31st of December 2019 is $201 million compared to Webjet's 44 million. So when it comes to earnings growth, kudos to Webjet to be able to pull off such a difficult task profitably, and the numbers speak for itself. Okay, what about their balance sheet? And for that, I need to sit down. Now, since multiple capital raising events has happened for both Webjet and Flight Centre, I want to show you a very simple model that I built by including the capital raising that they've done both recently and also in April, just to show you how much depth these companies have added to their balance sheet. Now, the one thing I do want to point out is a lot has happened since Feb and also December. That's when those numbers were first disclosed. So take the balance sheet with a grain of salt. I just wanted to point out the current ratios here. So before the capital raising, Webjet actually has a current ratio of 0.62. Now, current ratio is just current assets divided by the current liabilities. And with a ratio of 0.62, that means if Webjet doesn't make a cent in the next 12 months and sold off all of their current assets, they don't have enough to cover the current liabilities, which is a problem. However, after the capital raising that they've done since April and also recently, the current ratio has improved to 1.41, which means that in the next 12 months, even if Webjet doesn't make a cent, there is more than enough assets to cover its liabilities. So that's a really good position to be in, because that will allow the management team to make some adjustments to make sure Webjet can survive beyond the short term. Now, it's a very similar story with Flight Centre, and they have added $679 million worth of fresh capital into their current assets, and the current ratio has improved from 1.22 to 1.64. Now, for Flight Centre, they have actually secured additional bank facilities so that if they do need the money, they can draw it from the banks, and I didn't include it in the balance sheet here. I just wanted to show you that after the capital raising that they've done in April, they have improved their current ratio from 1.22 to 1.64. And again, this is a great situation for Flight Centre to be in, because that will buy them more time to make the right adjustments to weather the storm. Now, before we talk about economic moats, it's always good to look at the company's historical performance during pandemic-related downturns or economic downturns, just to see how they manage those events. So the pandemic we're facing now is probably the closest to the pandemic we faced in 2003. So I'll put that on the screen right now. So I had to dig very deep to find Webjet's track record from 2003 and beyond. And this is what Webjet's EBIT looks like from 2003 all the way to 2011. It seems like neither the downturns or the pandemic has really impacted Webjet's performance. But just remember that from 2003 onwards, that was when the mass adoption of internet happened. So they have benefited tremendously from that macro trend. And if we were to look at Flight Centre, during 2003 and 2004, they were relatively unimpacted. They took a bit of a beating in 2005, but recovered pretty quickly. And as you can see, they got a massive beating during 2009. Now, the beating Flight Centre took in the 2009 financial year was mainly caused by the US business. They had to close 40 stores in the US, and compounding that impact with accommodation operators and flight operators heavily discounting, that was a really tough year for Flight Centre. So if you compare the two side by side between Flight Centre and Webjet, it seems like Webjet is relatively unimpacted by pandemic-related events as well as economic downturns. So that could be both a sign of great management as well as riding the macro trend. Whereas if you look at Flight Centre, they are relatively unimpacted by an pandemic-related event, but more prone to being impacted by an economic downturn. Okay, it's time. Let's talk about economic moat. As usual, this is just my opinion, so make sure you take it with a grain of salt. With Flight Centre, their economic moat is mostly revolving around their brand. Having a great brand makes it easier to enter into the corporate travel market with very little resistance. But this is a very weak moat, because when times are rosy, those relationships and the brands that you have will accelerate your ability to win over those corporate accounts. But when times are tough, and especially those deals that you signed are under scrutiny, it's hard to win those accounts unless you can provide the best prices. And I really wouldn't look at Flight Centre's physical presence or existing consumer behaviors as an economic moat, because with a big enough shock, those existing consumer behaviors will be forced to shift. With Webjet, I have a bit more of a contrarian view, because I believe they have a network effect within their Webjet's B2B business. And I believe that they built the B2B business mainly because they are anticipating the online travel business to substantially decay over the next 5 to 10 years. So let me explain why I think the online travel industry will decay substantially first, and then I'll tie it together with the network effect moat. Now, when we think about Webjet and Flight Centre, especially the online business, we think that they're the most dominant players in the market. The truth of the matter is, they're not. So I want to quickly show you something here. One of the ways to tell whether a company has a very strong digital business is look at the organic search traffic. Now on the vertical axis, this is the number of sessions per month. A session could be you landing on the website via Google, that'll be counted as an organic session. On the horizontal axis, this is the number of organic keywords that they're ranking for on Google. At the bottom, branded traffic is essentially when you search for Webjet, and that's a brand term, and if you click on a Webjet result, that'll be counted as branded traffic. Now, if you search for Sydney to Brisbane flight and clicked on a Webjet result, that'll be counted as a non-branded traffic. So what we're really looking for here is high percentage of non-branded traffic, because ultimately these are the new people that you want landing on your website. Because branded traffic essentially just means that either these people already know you, are a customer already, or very familiar with the brand. So you don't really want more branded traffic, but instead you want brand new people. So this is when non-branded traffic comes into play. Now this positioning map is actually updated every couple of days, so the data points are very fresh. So if we look at Webjet, they have approximately 1.8 million sessions per month. Now these are just estimates. It doesn't actually mean that they are getting 1.8 million. It could be more, it could be less. And this is only organic search traffic. But if we look at Flight Centre has 1.4 million sessions per month. It has about 30% non-branded traffic. It's really not that far behind when you're comparing Flight Centre to Webjet. On the other hand, what we always forget when we are talking about digital business, especially OTAs, is we'll forget about Skyscanner. Skyscanner is one of the leading players in the marketplace, and the number of sessions that they're getting is 2.7 million sessions per month. And the non-branded traffic is approximately 50%, give or take. So if we were to compare Flight Centre against Webjet, yes, Webjet is slightly better when it comes to the organic search traffic point of view. But if you compare those two against Skyscanner is arguably way ahead compared to the other two. But the real competition is not even against Skyscanner, but it's actually against Google. Most customer journey starts from the search engine. And over the years, Google have really increased their presence when it comes to accommodation and travel. And the top result when you search for Sydney to Gold Coast flight or any similar queries is very likely going to be Google's result. And if you click into show flight, they are connecting you directly with the cheapest price possible in different airlines. And that completely renders online travel agencies pointless. And the only way to get above the organic search rankings that Google is creating is buying ads. So that's a really, really tough fight because you have to spend more money to show up higher than Google. And at the same time, you're paying a lot of agencies to help you rank higher organically on Google's search engine. Because Google controls the search engine, it's very hard to win that battle. So personally, I think the OTA business will wither down considerably over the next 5 to 10 years. And that brings me to the true economic moat for Webjet, and that's their network effect in web beds. Now the network effect in the web beds business is pretty straightforward. You have the accommodation suppliers of the world, and then you have the booking enablers. As web beds build up this supply, it enables a lot of the traditional channels with more options to sell to the travelers. Now, if these people make more money, that means the suppliers will make more money. And as the suppliers make more money, other suppliers will realize that they want to be on the platform too. And this is where web beds will have that advantage over time as they build up both sides of the marketplace. You can already see the network effect taking place by how much money they are making profitably with their web beds B2B business. So let's talk a little bit about the future outlook of the travel sector, and then I'll talk about which one I will pick if I had to choose between Flight Centre and Webjet. Now, seeing that the borders are opening up again for domestic travel, I think that is going to take anywhere between 2 to 3 years for international travel to recover back to pre-pandemic levels. Companies like Flight Centre and Webjet will need to maximize their output locally, whether that's in UK, US, or even Australia, and figure out ways to do that economically. And frankly speaking, I just think the travel sector has a long road to recovery, and short distance travel will be the key to staying alive over the next couple of years. If I had to pick between Flight Centre and Webjet, I will pick Webjet. because I think they were a lot more prepared than Flight Centre for the future. And building a double-sided marketplace profitably in such a short amount of time is a testament to their technical competency. But if you're gonna invest in them now, plan to hold them for at least 5 years moving on to the future. Full disclosure, I don't own either stocks, and let's wrap up the video with a portfolio update. Of course, this video is not intended to be financial advice and only for entertainment purposes. So here's a quick portfolio update. Now, on the Australian portfolio side, a couple stocks have recovered, but because our dollar is up quite significantly against US dollars, I want to take the advantage to contribute a little bit more towards my US portfolio side. So let's go over to stake so that I can show you what I bought and what I plan to buy over the coming week. I've contributed another 2,500 Australian dollars into this portfolio, which is approximately 1,700 bucks in US dollars. 700 of that will be split equally to my dividend growth stocks, so my classic ones, into Apple, Bank of America, BlackRock, and a few of the other classics. Now the rest will be invested into ARK Innovation ETF. I've been following ARK Invest for a very long time. I love what they're doing over there, and this ETF only invests in disruptive technologies, so gene editing, robotics, autonomous driving, fintech, and their expense ratio is a little bit on the higher side of 0.75%. I've done enough research to feel really comfortable with this investment, and I want to be part of the future. So I'm going to invest about $1,000 into this ETF, and I plan to keep contributing to this ETF. And as usual, yes, I do plan to hold them for at least 10 years, if not for the rest of my life. So let's come back to my dashboard. And at this point, if you've been following me, then you notice that Dropbox, GoPro, and I don't have any Nike shares anymore. Reason being is that, well, firstly, Dropbox, GoPro, and Nike are actually free stocks that's given to me by Stake whenever any of you do try Stake for yourself. And I'm not sponsored by Stake. I just use Stake because it's cheap for Australians to trade US stocks with, and it's just easy to use. So if you want to try Stake for yourself and wouldn't mind getting a Dropbox, GoPro, or Nike, I'll leave a link in the description box below. Now, the reason why I sold a lot of my free stocks for Tesla is because between the 4 stocks, Dropbox, GoPro, and Nike, I will give up all of them to own Tesla any day. And this is not me being a bandwagoner and jumping on the Tesla boat. I have been researching Tesla for the longest time, and I think for the upcoming YouTube check that I'm going to get, I'm gonna invest a big portion of that into Tesla. I bought in Tesla at approximately $1,300, and I'm gonna sell the rest of the Dropbox and GoPro and invest that back into Tesla as well. I think that even at $1,300, well, now it's at $1,500, it's still relatively affordable given what they can achieve in the next couple of months. So if you want a full video on that and for me to share all my research with you, make sure you gently smash the like button. If the video gets 1,000 likes, I'll do a full video on that. So thank you for watching this video all the way to the end. It really does mean a lot to me. And if you want to support me, just gently smash that like button right there, and that's more than enough. Now for my upcoming video, I'm going to be talking about Tyro payments. So if you're keen for that, make sure you subscribe to my channel, click onto the bell, so that when that video is ready, you'll be the first one to know. As usual, Otto will always do the honors and see you very, very soon.